Hey folks, it's Doc's Market Minute for Monday, February 22nd. I'm looking at the S&P 500 SPX chart here, and what I'd like to talk to you about today are the bear market rallies that we will see. They're going to be unusually strong, and this is what makes trading a bear market so difficult, because just when you think that it couldn't get any worse, which was just about a week ago, all of a sudden markets will flip around and pretend like nothing ever happened, and they rally like crazy. And this is due to several fundamental things. First of all, there's too many shorts to get in at the very bottom, and all of a sudden they're still covering. Even today, they're still covering those positions like, oh man, I can't believe I went short at the bottom. But this is what happens. They have to buy them back, and this helps provide that rocket fuel. What also happens is that people will see the bottom here and say, okay, let's go for a short swing to the upside. There's no reason why we can't make some gains on the way back up here. But what you'll also see is that overhead resistance creates this overhead supply up in this area where people are just praying right now. They're down on one knee, genuflecting, hoping that the price will get back up there so that they can make their position whole again. In other words, they went long back up here thinking that the price was going to bounce, and all they're looking for at this point is just to be able to sell out that position. And this is why we get massive amounts of overhead supply during these, and why rallies are sold into. So we are going to have strong rallies. We're going to have, very difficult consolidation up near here, and then it's going to tip over again. And when it stops doing that, we'll know that the bear market is over. So one of the things that I looked at in my premium newsletter video this weekend was tests of the 200-day moving average. Now, the 200-day moving average on the daily chart is this skinny green line that's here. And so you can see now it's starting to tilt down. We do have the old death cross, which is when the 50 and the 200 cross, the 50 crosses under the 200. We had one of these back in August, okay, and it cleared again to a golden cross. And for the first time in over 20 years, that golden cross did not hold up. So that's a very bad signal that occurred as we got into early January. And so, again, people are going to be flopping back and forth between bullish and bearish, and this is why people are going to have such a difficult time in the bear market, is days like today where we're up by over 1% and markets are pushing up against resistance, and you think that nothing bad is ever going to happen again. And just when everybody jumps over to that side of the boat, this is when the trapdoor falls out. So what I wanted to do this weekend was to see how often we can use that 200-day moving average as kind of a delineator between bullish and bearish. So I am going to expect to see the 200-day moving average tested from underneath many, many times during the process of this bear market. Well, not many times, but enough times to make it difficult. So let's go back in time and see how this handled this over the last two bear markets. We have to go way back here to these bear markets. So the last one that we had, again, in 2008, we got the death cross here. And then the price pretty much stayed underneath the 200-day moving average. We had one day in May of 2008 where the price tried to jump above and beyond the 200-day, and that turned into a shooting star, and the price started going down from that point. So you can see that the 200-day moving average, and in fact even the 50-day at some points during the very last part of the bear, was constraining the price, and it didn't get above that 200-day until things finally did cross to the upside. We got the golden cross, and that was off to the races. So that was the 2008 bear. Let's go back in time to the 2000 bear, right? So let's go all the way back here, and let's go through the same thing again. So the initial death cross happened later on in 2000. And you can see how well this constrained the price as well to the upside. So all of this price action stayed below the 200-day moving average, stayed below throughout all of these rallies. It got close several times, didn't it? Got close several times, but it just kept on going lower and lower and lower. And this is an interesting period of time that we had in late 2001, early 2002, where the market went basically sideways, and the moving averages started to tangle with each other, right? But we never got the full golden cross until we had one final flush, and this was that triple bottom that we had in 2002, early 2003, right? So bam, 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 finally got the reversal, and then up and at 'em we went. We got the golden cross there in spring of 2003, and then it was all over from there. So my point in bringing this up is not necessarily to say that we're going to have exactly the same type of market movements that we had in the last two bear markets. No, by no stretch of the imagination are we going to see the same thing. But just for a reference, we can see how strong some of these rallies were that went all the way up to the 200-day moving average, but were unable to get any kind of sustained move above and beyond that. So when we see the next golden cross, we're going to have to take that seriously. Although moving averages, anything to do with moving averages is just one indicator, and we need to use price action to really understand what's going on. But moving averages are very, very easy to put onto a chart. They're very easy to interpret. So as long as the price is staying under these 200, we're going to be selling into the rallies, buy the dips, sell the rips, and the song remains the same. So I hope that helps. Thanks for listening, and we'll see you tomorrow in tomorrow's update. Take care.